Most investing videos either overwhelm you with complex strategies or pitch you dreams with no backup. This isn't one of those videos. If you've ever felt like investing was confusing, time-consuming, or just not made for regular people, you're in the right place. Today, I'm breaking down a portfolio so simple anyone can start with it, yet so effective it can grow into 7 figures over time. I'm talking about just 3 ETFs, all built on timeless investing principles, but upgraded for today's economy to handle challenges like inflation, interest rates, and market fluctuations. And in the end, I'll show you and Ernie how this simple 3 ETF portfolio can turn a $10 daily investment into a retirement fund worth over $1 million. But first, where did this idea even come from, and why does it still work so well even in 2025? To answer that, we've got to rewind a little. It all started with a shift in mindset. Back in the early 2000s, a group of everyday investors, people who were tired of trying to beat the market, began rallying around the simple no-nonsense investing philosophy of Jack Bogle, the founder of Vanguard, and built what is now known as the Boglehead 3 fund portfolio. It was kind of genius how basic it was. One fund for US stocks, one for international stocks, and one for bonds. That's it. No stock picking, no guesswork, just broad diversification and long-term growth. And it worked for most people. And over a couple of decades, this minimalist strategy outperformed many actively managed portfolios with far less risk. And while Wall Street was busy making things more complex, Bogleheads kept it simple and won. This philosophy attracted everyone from college students to retirees because it didn't require predicting the next big thing. It just worked slow, steady, and powerful. But we're not in 2000 anymore. Interest rates have shifted. Inflation is sticking around longer. Passive income is a top priority. And global markets look very different today. At the same time, people are craving more flexibility, more growth, and more control over their cash flow. Bonds, they're no longer the reliable safety nets they used to be, especially when dividend ETFs are offering better yields and long-term upside. So, does that mean that the Boglehead model is outdated? Well, the answer to this is yes and no. The core principle is the same. Diversify, stay consistent, keep costs low. But what if we could keep that foundation and just upgrade it a little? What if we swapped in a few smarter ETF choices designed for today's economy? Higher returns, better income potential, and more flexibility. That is exactly what I've done here. I've taken the same structure, but plugged in ETFs that are built for how money works in 2025. Think of it as the Boglehead 3 Fund Portfolio 2.0. Same foundation, upgraded engine. So, before we break it down piece by piece, let's make sure we're on the same page. What exactly is an ETF? Well, an ETF, short for exchange-rated fund, might sound fancy, but it's actually super simple. It's basically a bundle of investments, like stocks or bonds, packaged into a single fund you can buy and sell on the stock market. Think of it like a playlist of top-performing songs, but instead of music, you're getting a curated mix of assets. Instead of picking individual stocks, you invest in one ETF that automatically spreads your money across dozens, hundreds, or even thousands of assets. That means instant diversification without the headache of tracking multiple companies. And because ETFs are traded just like regular stocks, you can buy or sell them throughout the day at market prices. The best part, most ETFs have super low fees compared to mutual funds or actively managed accounts. That means more of your money stays invested and compounds over time. So, now that we've got the basics down, let's talk about how to actually use them. Starting with the 3 simple rules that make this modern 3-fund portfolio so powerful. First, pick one ETF per category. The original Boglehead model used 3 core categories: US stocks, international stocks, and bonds. In this modern version, I've upgraded the international and bond categories with more growth and income potential, but the structure stays the same. You only need one solid ETF for each category to keep it simple, clean, and easy to manage. Second, set a clear goal. Don't just invest blindly. Know what you're working toward. Do you want to retire by 60? Cover your rent with passive income. Or want a lump sum retirement fund? Be specific. The clearer your goal, the easier it is to stay motivated and stick to the plan even when the market gets rocky. Third, and most important, stay consistent. This goal tops everything else. Listen, you might think $10 a day doesn't move the needle, but do it for 30 years, and in the end, I'll show you how this portfolio can turn $10 a day into a portfolio worth over $1 million. The key isn't timing the market, it's time in the market. Automate your contributions, and don't overthink the short-term noise. Stick to these 3 rules, and you're already ahead of most investors out there. But even a great strategy like this can fall apart if you make the classic beginner mistakes. And trust me, most people do. So before we look at the actual ETFs, let's talk about what not to do. One big slip up: chasing the hype. Just because a stock is trending doesn't mean it belongs in your long-term plan. Stick to your ETFs and ignore the noise. Another one: checking your portfolio too often. Watching every dip and spike only creates stress and leads to bad decisions. This portfolio is built for decades, not days. Lastly, switching ETFs too quickly. You don't need the hot new fund every year. Pick strong ETFs, then stay put. Avoid these traps and your chances of hitting that $1 million mark go way up. Now that we've cleared that up, let's break down the first and most important part of the entire strategy: your foundation ETF. This is your main growth engine. If the rest of your portfolio is the structure, this is the concrete it stands on. It gives your investment stability, strength, and long-term direction. And that's why we mimic the US stock market. Historically, the US has outperformed almost every other market globally. The S&P 500 alone, which tracks the 500 largest companies in the US, has delivered an average annual return of around 10.5% over the last 30 years. That's not just solid, that's elite. When you invest in an ETF that tracks the S&P 500, you're not betting on one company. You're owning tiny pieces of the biggest, most powerful businesses on the planet. Apple, Microsoft, Google, Amazon, and hundreds more. You're holding the same assets that drive the global economy. Now, what makes this so powerful for long-term investors is the combo of capital appreciation and dividend income. Capital appreciation is when the ETF's share price goes up over time. Dividend income is the cash paid out regularly, usually quarterly, just for holding the ETF. And when you reinvest those dividends, that's when things get wild because you're earning on your earnings. And that compounding effect becomes a money-making machine over the years. The ETF I recommend for this category, the foundation, is the SPDR Portfolio S&P 500 ETF, ticker symbol SPLG. This fund is designed to track the full performance of the S&P 500 with ultra-low fees, high liquidity, and proven returns. It's one of the most cost-effective ways to get massive diversification in one single purchase. As for its reliability, SPLG has paid dividends for 17 consecutive years. And for the last 4 years, it has increased those dividends. That means not only are you getting paid, you're getting paid more every year. In a world where uncertainty is the norm, that kind of track record matters. The average annual return of SPLG is about 10.71% with a dividend yield of 1.28%, 28%, and a dividend growth rate CAG of 7.29%. Next, I'll show you how much this ETF alone can grow at $10 daily investment over time, just as a reference. So, let's put this into real numbers. Say John invests $10 a day or $300 a month in this ETF and reinvests the dividends. Here's what happens. After 1 year, he would have invested $3,600, setting the stage for future growth. After 10 years, he's looking at $62,414. By year 20, it's $246,645. And at year 30, his total portfolio value will hit $777,669. He would have invested $18,000 total over 30 years. But thanks to market growth and reinvested dividends, his portfolio would gain $669,669 in value. Out of that, around $35,344 comes directly from dividends being reinvested and $634,325 from capital appreciation. Here's something most people overlook: the peace of mind this brings. You're not glued to CNBC. You're not stressing over earnings reports or trying to guess what the market will do next. You're simply investing in the backbone of the US economy and letting it grow. That's exactly why this is your foundation. Because when it comes to your core portfolio, you don't want chaos. You want something with a rock-solid track record built on companies that have shaped and will continue to shape the world. SPLG gives you that. It's steady, it's proven, and it just works. Now, in the end, I'll show you and Ernie how this combined with 2 other ETFs can turn a $10 daily investment into a retirement fund worth over $1 million. Remember, the foundation ETF isn't where you go hunting for massive gains. It's where you plant the seeds that grow into trees slowly, steadily, predictably. So, if you're someone who wants solid long-term growth, reliable dividend payouts, and a totally passive way to invest, this is it, the cornerstone. But I'm not stopping here. In the traditional Boglehead model, the next piece would be bonds. But I'm flipping the script and replacing bonds with something that's a whole lot smarter. You see, bonds used to be the safety net of any solid portfolio. Their job was to protect you when the market got rocky, give you a bit of steady income, and balance out the risk from stocks. And back then, that made a lot of sense. But times have changed. Today, bond yields are low. Inflation eats away at your returns. And if you're in your 20s, 30s, or even 40s, you need more than just safety. You need growth. That's why in this updated strategy, I'm replacing traditional bonds with something that does everything bonds were supposed to do, but better. A dividend ETF. Dividend ETFs give you income just like bonds, but they also give you something bonds usually don't: growth. These funds invest in companies that share their profits by paying out regular dividends. And a lot of those dividends, they grow year after year. Plus, Unlike bonds, the actual value of the ETF can rise over time, too. So, now you're building wealth in two ways: steady payouts and rising share prices. That's a win-win. The ETF I recommend here is the First Trust Dividend Strength ETF, ticker FDTS. This fund focuses on high-quality U.S. companies with strong fundamentals and a history of solid growing dividend payments. It's like owning a basket of reliable income machines without the stress of managing individual stocks. And FDTS has the track record to back it up. It's paid dividends for 16 straight years and increased them for the last 3. That kind of consistency makes it an ideal upgrade from traditional bonds. Now, let's look at the metrics behind FDTS. Dividend yield is 1.99%. The average annual return is 6.78% and dividend CAGR is 13.42%. Let's say Ernie continues his strategy of investing $10 a day, the same as with SPLG, and reinvests every dividend from FDTS. Here's what that looks like. After 10 years, his FDTS investment will be worth around $56,719. Stay on track for 20 years and it'll be about $239,369. And if Ernie commits for 30 years, his portfolio will be sitting at $1,189,999. Keep in mind, John only invested $18,000 total over 30 years. Of the total value added of $181,999, $629,169 comes from reinvested dividends and $451,930 from the share price appreciation over time. Unlike bonds, dividend ETFs like FDTS also benefit from rising interest rates. So when rates go up, many dividend-focused stocks become more attractive, not less. That helps buffer your portfolio and keeps the income flowing. But this isn't just about math. It's about mindset. Too many investors see bonds as a must-have because they were always told to have them. But in a high-growth, high-dividend ETF like FDTS, you're not sacrificing safety. You're upgrading it. You're earning income that grows. You're investing in companies that also increase share price. And you're avoiding the slow crawl of bond returns that barely outpace inflation. Let's put this into perspective. If Ernie had stuck with a traditional bond ETF offering 3% annually, his 30-year portfolio might have landed somewhere around $175,000 to $200,000 tops. By switching to FDTS, he ends up with nearly 6 times that amount. And just like with the Foundation ETF, this one works best when left alone. Don't panic during down years. Don't swap it for the next trendy fund. Just keep investing and let compounding do its work. Okay, so far we've secured growth through SPLG and layered on strong growing income through FDTS. Now, let's go for the final piece of the puzzle. The ETF that adds explosive potential and pushes your portfolio into high gear. Traditionally, the third leg of the Boglehead 3 fund portfolio was international stocks. The logic is simple. Diversifying beyond the U.S. economy and reducing your risk by investing in companies across Europe, Asia, and emerging markets. But here's the problem. International markets have underperformed U.S. markets for years. And even more important, today's biggest U.S. companies already have global reach. Apple sells iPhones in China. Microsoft runs data centers across Europe. Google, Amazon, Meta. They operate in every major country in the world. So, if you're investing in these giants through a US-based ETF, you're already getting international exposure just without the lagging performance. So instead of playing defense with traditional international funds, let's aim for something more aggressive, more future-focused, a growth ETF. And for this, I'm talking about the Technology Select Sector SPDR Fund, ticker XLK. This ETF gives you access to the biggest and boldest US tech companies, the same ones that have fueled most of the S&P 500's gains over the past decade. Now, XLK isn't your typical dividend ETF. It's not about consistent income. It's about serious long-term capital growth. But even so, it has paid dividends for 16 consecutive years and increased them for the last 3 years. That means you're still getting some income while riding the wave of massive growth potential. It has a dividend yield of 67%, which on average grows by 7.74% each year. But most importantly, it has an average share price appreciation of 18.27%. So let's run the numbers again with Ernie investing $10 a day in this ETF. After 10 years, it'll be worth $87,331. Stick with it for 20 years and it'll be around $559,531. And at the 30-year mark, his portfolio will be an incredible $93,876. That's with the same total contribution, just $18,000 over 30 years. The rest is pure growth. And remember, he only contributed $18,000 in total. About $2,976,761 will be from capital appreciation and around $9,116 will be from reinvested dividends. That's nearly $3 million in value added just from staying consistent and trusting the long game. Now, yes, tech is volatile. It doesn't go up in a straight line. And there will be dips, there will be corrections. But if your investment horizon is 10, 20, 30 years, few sectors can touch what tech has delivered. That's why XLK isn't just a fun bonus. It's a critical part of this modern 3-UND portfolio. It pushes the growth curve higher. It gives your portfolio explosive upside. So, now you've got the full setup. A simple, powerful portfolio designed for today's world. Here's how the overall portfolio breaks down. Still simple, but now even more strategic. And I'm including one backup ETF per category for your consideration. For your foundation, you've got SPLG, a low-cost ETF that tracks the entire S&P 500. And if you want a similar option with a bit more liquidity, there's SPY, which does the same job with slightly higher fees. For income, I recommend FDTS for its strong dividend growth. But if you're leaning more toward higher yield and consistency, SCHD is a fantastic addition here. Solid companies, steady payouts, and a great track record. And for growth, XLK is your access pass to the biggest names in tech. But if you want to take it a step further and tap into the future of semiconductors, SOXX gives you direct exposure to that booming sector. For this video, I've selected SPLG, FTDS, and XLOC for the overall portfolio. Now, to calculate the portfolio's investing metrics. To calculate the dividend yield of the entire 3 ETF portfolio, I use a simple average based on equal weighting. Each ETF, SPLG, FDTS, and XLK, has its own forward dividend yield. SPLG at 1.28%, FDTS at 1.99% and XLK at 0.67%. Since this portfolio assumes equal distribution across all three, I added those three yields together and divided by 3. The math looks like this. 1.28 plus 1.99 plus 67 thirds equals 1.31%. You can do the same for dividend growth and average share price appreciation. Put it all together and this modern three-fund setup delivers some pretty impressive numbers. Combined dividend yield of 1.31%, dividend growth rate of 9.46% and average annual return of 11.92%. But what do all these numbers really mean for your future? That's the part that matters most. And now we get to see what happens when these three ETFs come together and work as a team. You don't need 10 different funds, just these three core ETFs. One for growth, one for income, one for stability, and maybe a backup or two if you want to tweak things down the road. Together, they cover everything you need. Solid returns, regular dividends, and the peace of mind that comes from a well-balanced strategy. So, let's say John sticks with the plan. He invests $10 a day, around $300 a month into this portfolio. He reinvests every single dividend and doesn't touch a thing, just stays consistent. After 10 years, his portfolio will be worth about $66,471. In 20 years, that number will grow to around $288.14. And by the 30-year mark, John's investment will have become a total of $1.1286. Out of that total, about $53,644 will come directly from reinvested dividends. The other $850,442 is pure capital appreciation. So, in the end, the total value added to John's portfolio will be an incredible $94,086. All from staying the course and letting his 3 ETF strategy do its thing. This portfolio isn't one size fits all. You can shape it to match your goals, timeline, and risk tolerance. Want faster growth? Put more weight on XLK or SOXX, the growth ETFs. They're more volatile, but over decades, they've delivered massive returns. Need more passive income? Lean heavier into FDTS or SCHD. These dividend ETFs pay you regularly and their payouts grow year after year. Prefer stability and slow steady gains? Well, then allocate more to SPLG or SPY. These foundation ETFs track the market broadly and keep your portfolio grounded. The key is this. Keep your structure simple, stay consistent, and let time do the heavy lifting. Want to know how to turn a $10,000 investment into a $3.5 million portfolio using ETFs?